But first, and let's be honest here, it has been a horror week for the share market, with hundreds of billions of dollars wiped from markets all around the world. The ASX 200 lost 8% in just the past week. On Tuesday, it had its biggest one-day fall since before the beginning of the COVID pandemic. Markets were spooked by the prospect of higher and more frequent interest rate hikes and also inflation. In the US and the UK, at least, markets are pricing in a future recession. Edward Boyd starts our coverage.
At Sky News this year, we've been telling you that Australia is sleepwalking into a recession. Well, this week, global markets finally caught up with that view. Equity markets plunged across the world, a forward warning, perhaps, of the future economy. Recession.
As it stands right now, I believe there will be a very short and shallow recession.
Whether we get a soft landing, a recession, or we are already in the start of a slowdown, as I believe, there's going to be economic consequences here.
The reality of it is, with inflation at a 40-year high and interest rates that were record lows, a recession may be the price we have to pay to get inflation under control.
70% of academic economists in the US are predicting a recession in 2023.
US Federal Reserve Chairman Jerome Powell only used the word once in his hour-long press conference on Thursday.
This means the FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labour market. That's what we're trying to do.
The US Fed lifted rates by 75 basis points, the biggest hike in 28 years. The bank is tipped to raise rates by the same amount next month in its July 27th decision. US inflation set a fresh 40-year high in May of 8.6%, despite rates being raised in March and May.
Again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation, really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world. I mean, lots of countries are looking at inflation of 10%.
Our own central banker, Philip Lowe, this week told the ABC inflation here will soar to at least 7%. But he refused to use that word, recession.
By the end of the year, inflation will get to close to 7%, and we need to chart a course to bring it back down. We're expecting the Australian economy to continue to grow pretty strongly over the next 6 to 12 months. There's still a bounce back from all the COVID restrictions. People have got these savings that I've talked about to draw on, and the current rate of saving is still quite high.
The RBA raised rates by 50 basis points last month. It's now expected to lift rates by the same next month and keep pushing rates up for the rest of this year to potentially 3%.
One of the, old central bank playbook rules was don't get too far away from reality lest you have to try and catch up in a quick sequence of steps. And when you have to catch up quickly, calibrating exactly where you need to get to when becomes much more difficult. Unfortunately, that's the situation we're in. So the risks around the economic cycle have gone up.
Fund manager Andrew Martin at Alphinity says soaring inflation and rising interest rates make the outlook very difficult to predict.
Risks are going up at the moment. The faster that central banks have to raise rates to rein in inflation, the harder it is for them to engineer a soft landing. It's hard to engineer a soft landing normally, but they're trying to do it into a really volatile environment. I mean, it's not just inflation, right? We've got a war in Eastern Europe that's affecting commodity prices and the whole, energy structure in Europe. You've got COVID, not only around the world, but specifically in China, a huge economy that's really struggling with COVID that affects Australia. So you're trying to engineer this soft landing by raising rates off the lowest interest rates in history, and you're raising them at a rapid pace that's rarely seen into a really volatile environment. It sounds like there's a fair bit of risk that economic growth is going to slow down.
As a fund manager, what do you do with your portfolio in times like this?
It's a particularly difficult time from a portfolio construction point of view. Trying to pick where macro goes week to week is really difficult at the moment, and so I'd say what we've been doing really for the last 6 to 9 months is, as we've seen this coming, is to diversify the portfolio more. We go from quite a cyclical tilt last year and into the beginning of this year to adding in defensives, companies that can hold up in a recession, adding in companies that benefit from rising rates. Just making sure you're a bit more diversified and frankly, don't be afraid to sit on the fence a bit until things evolve and you see how things actually play out.
For Felicity Walsh at the local branch of US investment firm Franklin Templeton, the outlook for interest rates is more certain. Her clients are now asking when they should start putting money back into the market.
It's wonderful talking to clients at the moment because although there's a truckload going on in markets, it is, we've got some direction now. We didn't have any direction for so long. We didn't know what the central banks were going to do. It's very clear now what they're doing. We obviously can't say how far they'll go and how quickly they'll need to do it, but certainly in terms of direction. So that gives a lot more stability in terms of what portfolios might look like. So, as I mentioned, huge increases in fixed income allocations, thinking about increasing equity, when is the best time to get back into equities?
The bond market has reacted sharply to rising interest rates. Australian 10-year government bond yields touched 4.2% this week, the highest since 2013.
Yeah, so look, I think bond markets are really exciting. I'm an actuary, so I love fixed interest. Normally the boring asset class. Look, it's really coming into its own. Clients have been hugely underweight. Some clients have removed fixed income entirely from their portfolios. We're seeing a huge sway back. Duration, obviously. Great time to be getting into duration, probably, certainly in my career. So really thinking about how to play that, potentially overweight duration. And it's a great time with where rates are to start reintroducing that to the portfolio.
But locally, economists at least aren't forecasting a recession anytime soon. But in 12 months' time, it might be a different story.
The Australian economy is doing really well, and to be honest, you've got to remember that monetary policy takes 12 months to have much impact. So if you're going to have a recession, it's not going to be this year, it's going to be next year. And I think markets are just anticipating, and the bottom line is the Australian economy is very good.